Good morning, ladies and gentlemen. Welcome to the Star Health and Allied Insurance Companies Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. I now hand the conference over to Mr. Pratik Patil from Adfactors PR Investor Relations team. Thank you, and over to you, sir.
Thank you, Lizanne. Good morning, everyone. From the senior management, we have with us Dr. S. Prakash, Managing Director, Mr. Anand Roy, Managing Director, Mr. Nilesh Kambli, Chief Financial Officer, and Mr. Anish Srivastava, Chief Investment Officer. Before we begin the conference call, I would like to mention that some of the statements made during the course of today's call may be forward-looking in nature, including those related to the future financial and operating performances, benefits and synergies of the company's strategies, future opportunities, and growth of the market of the company's services. Further, I would like to mention that some of the statements made in today's conference call may involve risk and uncertainties. Thank you. And over to you, Mr. Anand Roy, sir.
Thank you, Pratik, and a very good morning to all of you. Thank you for joining the earnings conference call of Star Health and Allied Insurance Company for Q1 2023. My name is Anand Roy. I'm the Managing Director of this company. I will give you a brief overview of the industry trends and developments that we have witnessed in the last few months, as well as walk you through the company's performance in terms of premium and distribution. My colleague, Dr. Prakash, will cover the financial performance and aspects related to claims, including the steps that are underway to manage them. In Q1 2023, the health and PA industry, the size was rupees 22,833 crores with a growth rate of about 20.6%. The growth was driven by 27% growth in group health, 33% growth in government health. Retail health insurance grew at 11.1% in Q1 FY23 on a very high base in the last year. The 4-year CAGR of the retail health segment has been 18%. Now coming to Star Health Insurance, our GWP grew by 13% in Q1 FY23 over Q1 of FY22 to rupees 2,466 crores, with the retail health segment growing by 20.3% in the same period versus industry retail health growth of 11.1%. So we have grown at double the size of the industry as far as retail health segment is concerned. In Q1 FY23, Star Health has registered 32% market share in retail health, which is 3x the second largest player in the industry. We have also increased our market share by almost 300 basis points in the Q1 as far as retail health business is concerned. As far as premium acquisition share is concerned, Star Health has registered 53% retail health acquisition market share, which is the highest for us in the last 3 quarters. Agency business has continued to contribute around 81% of the overall business. Our agency strength has increased to 566,000 with an addition of approximately 17,000 agents in the first quarter over FY22. Corporate agents, banks, and other tie-ups have picked up momentum, and the premium from this segment has grown by 57%. The highlights in Q1 FY23 for us were as follows. Premium and distribution. We introduced a product, Star Women's Care Policy and Star Premier Policy. The products launched in the Q4 of FY22 are doing very well. Our contribution from specialized products has increased to 17% in Q1 of 2023, and we continue our journey of premiumization of our product portfolio. This contribution is the highest ever we have recorded. The average sum insured of new policies has increased by 19% on a year-on-year basis to INR 8.7 lakhs per policy. We have introduced one new product, that is Star Health Assure Insurance. This product is an upgraded version of our Family Health Optima policy, which is one of our leading products. The Star Health Assure product has extended features and with much better pricing. We have taken a price revision in Star Medi-Classic insurance policy. This product contributes 6% of our retail premium. The price increase is approximately 25% and is effective from July 22nd onwards on the new premium. We have recently tied up with Common Services Center under Ministry of Electronics and Information Technology. There are over 5 lakh CSC functioning across the country as delivery points of government and public services for the rural population in rural, semi-urban and urban areas. This tie-up is a step towards increasing our health insurance penetration in rural markets, and the rural business for us is growing in excess of 75%, with increasing contribution coming from online policy issuance in these markets also. We also continue to focus on strengthening our bank assurance distribution for both indemnity and benefit products. We have recently tied up with IDFC First Bank for distribution of various health insurance solutions. The health benefit plans, including groups such as critical illness and hospi cash, grew by 30% in Q1 2023. As discussed in our previous quarterly earnings call, we have exited large group health insurance business as demonstrated by the 41% reduction in group health premium during first quarter of 2023. This segment is currently characterized by poor lifetime value, and we are very selective in this particular line of business. As reiterated previously, we remain very positive on the SME segment and non-employer-employee groups. The non-employer-employee group policies are largely sold to the retail customers of our banks and NBFC tie-ups. And if we continue these policies, if we include these policies, our overall retail growth would be 22% for the first quarter. We intensified our digital initiatives during the quarter. Some of the outcomes of the digital initiatives were our app downloads have reached 1.56 million downloads. 73% of our active agents are now using our digital solutions. Digital policy issuances has gone up to 64% in the first quarter of FY23 versus 60% in FY22. Digital sourcing defined as premium collected directly from our website as well as from our third-party web aggregators and online brokers has grown by 29% year-on-year and now accounts for 8% of our overall GWP for first quarter FY23. Now I hand over to my colleague Dr. S. Prakash to handle the claims and other related matters.
Thanks, Anand. Very good morning to all of you. Before the claims, on the cashless side, the share of hospitals with some form of pricing arrangement is close to 85%, and we are addressing our cashless claims with a turnaround time of around 90%. We have also initiated the process of identifying hospitals called valuable service providers. Currently, we have all over India 1,559 hospitals as valuable service providers. And this VSP helps our customers to get hassle-free medical attention and quick processing of claims. Over time, we expect to have better control on claims traffic to the valuable service providers by negotiating better price and offering a superior experience. We have stepped up our teleconsultation. We call it as Talk to Star. We have done close to 7 lakh consultations till date and wellness programs. Talk to Star cuts claims cost by giving customers access to experienced doctors for second opinion and alternate medical solutions. Coming to the financial performance, the combined ratio for Q1 FY23 has improved to 98.2% versus 121.1% in Q1 of FY22. The improvement in combined ratio is achieved through claims ratio improvement. The claims ratio in Q1 of FY23 has improved to 66.3% versus 91% in Q1 of FY22. The current period claims ratio has 0.7% impact of COVID claims. In Q1 FY23, there is an element of claims inflation for non-COVID claims due to hospitals charging for RT-PCR test, masks, gloves, and other protective equipment. Expense ratio for Q1 2023 increased by 1.8 percentage points to 32% from 30.1% of Q1 FY22 due to lower premium base and claims processing cost of 3% in Q1 2022 versus 1% in Q1 2023. So in terms of profitability, Q1 2023 was a profitable quarter for us with a profit before tax of INR 288 crore and profit after tax of INR 213 crores, 213 crores. So the gross COVID claims incurred during the quarter amounted to just INR 20 crores and non-business ESOP cost was INR 55 crore. Profit after tax before non-business ESOP cost is rupees 255 crore. Our investment assets have grown to 11,463 crore in Q1 2023 versus INR 8,302 crores in Q1 2022. Investment leverage, which is investment book to net worth, is now 2.3 times as on 30th June 2022. Solvency as on 30th June 2022 is 1.87 times compared to 1.67 as on 31st March 2023. With the normalization of claims, our solvency is shifting to premium basis as discussed during previous calls. This solvency is achieved through obligatory, the mandatory 4% reinsurance. All things being same on the premium basis of solvency, our solvency as on June 30th, 2022 would have further improved by approximately 20 points. We appreciate the steps taken by Insurance Regulatory Development Authority of India, which will catalyze greater penetration and expand total addressable market for the entire industry. It will make the industry more competitive based on market determined rather than regulatory determined terms. The regulator's recent extension of the use and file guidelines to all health insurance products will enable the industry to launch innovative and customized products at a faster frequency. To conclude, our focus on the attractive retail health segment continued during the quarter, and our efforts are in progress to manage and control claims outgo and claims inflation. We believe that we are in a good position to take advantage of the industry's long growth runway. Thank you all.
Thank you. Should we open up for questions?
Yes.
Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Swarnabh Mukherjee from BNK Securities. Please go ahead.
Good morning, sir. Thank you for the opportunity and congrats for a great set of numbers. So my first question is on the claims side. So two parts to that. First of all, you mentioned that there has been a claim inflation in terms of additional costs that the hospitals are charging. Does this mean that this could be, something that will continue, and would that mean that you would continue to expect a slightly higher loss ratio than you have guided previously? That is the first part of the question. The second part is on the COVID claims. So this 20 crores of COVID claims that you highlighted, is this from the claims raised in current quarter, or is this from old claims? And given that we are going through some a wave of COVID right now, so do we expect this to spill over to the current quarter, that is Q2 as well? So that is my first question.
Fine. So the impact of COVID claims, the 0.7% which we are trying to mention, it is for this quarter. The disease that occurred in this quarter, claims that have come in this quarter, and what we have paid in this quarter. And with regard to the hospital charging for the RT-PCR test and other stuff, protective equipment, this has become a routine given that, the long run of the pandemic. And we have taken all efforts to see that a very, very basic price is paid for these protective activities. So hence, going forward, I don't think that it should have a big impact on the average we pay for any hospitalization cost.
Sir, impact of that on the loss ratio, if you could throw some light on.
It's only 0.7% in this quarter, and going forward, so the real impact of COVID is 0.7%, but the non-COVID impact, it's a small percentage. Maybe I can say some 2 to 4% in every claim will be the cost of these non-COVID related, the COVID related tests done on medical admissions and surgical admissions.
Sure, sir. Sir, two clarifications from your opening remarks, if I could ask. One, in terms of OPEX ratio, what you mentioned, if I understood correctly, it is because of a lower scale in the first quarter that has resulted in the numbers look slightly higher, or anything else to read on to that? That is the first one. And second is on the solvency. So you mentioned that if you are moving to a premium method, so this quarter you have completely applied the premium method, or if you move fully to a premium method, should we have like that, what increase you have highlighted?
Yeah. So Swarnabh, the first thing on the expense ratio, Q1 is a small quarter, so it's a low premium base, whereas the expenses are fixed. So Q1 will always have a slightly higher expense ratio compared to the full year average. Second thing is this: we used to transfer 3% cost from OPEX to claims last year. We changed this method in quarter 2 to 1%. So which is applied in the current period as well. But for quarter 1, we still had transferred 3% OPEX from cost of OPEX from OPEX to claims. So that was slight anomaly in quarter 1, which will get corrected quarter 2 onwards. So these are the two reasons on expense ratio.
If you could, sorry, sir, if you could kindly explain the rationale for moving 3% of the cost to from claims to OPEX. I'm sorry, I'm not aware. If you could just explain that up.
So now we can take this offline. Basically, the logic is that our TPA is in-house. Okay, so when it's an external TPA, you pay the cost of the TPA and you book it directly as claims. But because we have an in-house TPA, we have our own set of doctors who are employed, we transfer this cost from OPEX to claims. So that is what all insurance companies do who have in-house TPA.
Okay.
So with scale, this cost has reduced, which we have taken the impact in quarter 2 onwards. On the solvency ratio, currently we are still on the claims basis of solvency. What we mentioned in the script, that there is still some headway left between premium and claims, and if we do currently on premium basis, the solvency will further improve by 20 points.
So the convergence will happen by September. As we keep on growing the premiums and the claim ratio starts to normalize, we believe that around September it should converge.
So, sir, 20 point means from 187 odd to around 207 odd. That is what you mean.
Yes.
Okay. Very helpful, sir. Thank you so much and all the best.
Thank you. The next question is on the line of Sanket Ghoda from Spark Capital. Please go ahead.
Yeah. Thank you for the opportunity. Nilesh, I have one simple accounting question. This NEP on unexpected risk reversal thing or the reserve release which happens, should we assume this will be a common phenomena in first quarter because fourth quarter is such a big quarter? So should we expect that this reversal will consistently happen in first quarter of every year, and which will lead to higher NEP, probably even better than GWP number?
Okay. This will be a feature of the first quarter every year on 1/365 basis because quarter one is small compared to quarter four. That is where we say, in quarter four, though the combined and everything is fine, because we don't have the concept of that in quarter four, in spite of having a good combined ratio, there is always an underwriting neutral or loss. Similarly, in quarter one, because that earnings come, the release happens in quarter one. The quarter one GWP is smaller. This will always be a phenomenon of quarter one. This was there in last year as well. On a 1/365 basis, the NWP is lower compared to the net earned premium.
So Nilesh, is it safe to assume or is it okay to tell that if there is URR increase every quarter on quarter from second, third, fourth quarter, then if you remain at 65, 66 kind of a loss ratio for Q2, Q3, Q4, the quantum of underwriting profit which we would make for 95, 96 combined will be lower compared to what we have made in Q1 to FY23 then?
No. So the combined ratio of 95, 96 will give a certain underwriting profit for the whole year. Once you do the whole year numbers, it will not be representative of quarter one. It will start to normalize.
Okay, Nilesh, I got it. The another question which was that in the current quarter, if you see the ANH claims, that is claims at the preferred network hospital, have come down to 56% compared to 64% in the last year. So this is an anomaly, or this reduction from 64 to 56 is also one of the reasons why our claims ratio came little higher. Maybe we were expecting around 65. It came at 56. So just wanted to check that played a role, or this is just a quarter aberration.
Hi, Sanket. So here, when it comes to pricing arrangement with the hospital, that 56% refers to the number of hospitals which have a package for surgical procedures with us. But there are hospitals specializing in surgical procedures. There are multi-speciality hospitals and those that do mostly medical and pediatric cases only. So in medical and related conditions, we have what is called as a mini SOC arrangement, where we fix the cost from the professional charges, the room rent, and the common diagnostic tests that are done. So, and there are hospitals which give us an overall discount on the total amount. So I'm trying to say that overall the pricing arrangement is what we discussed, and 56% what is mentioned is the pricing that surgical package that we have with hospitals. But for your understanding, overall our pricing arrangement with the hospitals is on the progress, and we are able to control our average claims paid quarter on quarter, and we are able to see that we are progressing in that direction.
Got it, sir. Sir, out of the total claims paid in the current quarter, how much would be cashless and how much would be reimbursement? Because this 56% is referred only to the cashless part, right?
Cashless is around 65 to 70%. Usually we have cashless by number around 65 to 70%. And if you look at the medical inflation, which is the average increase in the claims that we pay, you will observe that we are able to have a much lesser price hike compared to the inflation. And that is because, we are in the industry for 15 years. We know the language, we talk to hospitals, and we have the strength of large numbers.
Right. Got it, sir. Sir, second thing which just wanted to compare is that now we have use and file way of repricing the product. And you alluded to the point that the average claim size for the same ailment structurally probably has gone up because of the procedures adopted by hospitals to treat a patients have changed, because probably they are doing some mandatory RT-PCR, they are doing some other tests which previously were not done. So there is an inflation in the claim size. So repricing in the products will we see very frequently, and even Anand, when he said that we have seen a price hike, we have taken a price hike of around 20% in Mediclassic product, which is 6% of the total business. Is it actually done under use and file thing? And we can see these kind of changes happening more frequently compared to what we have experienced in the past, and therefore we have a better control on the loss ratios going ahead.
So see, repricing of the product will be a constant phenomena. We will be evaluating our internal loss ratios and combined ratios and then taking corrective measures. But having said that, the company has always been very, very judicious in pricing its products and repricing them also. So we are very well aware of the market dynamics, and we do not intend to make repricing as the only option. Our agenda is to negotiate hard with the hospitals, bring the medical inflation under control, and also simultaneously look at pricing products appropriately. So Mediclassic product is being repriced after 3 years, and I think the value that the product provides justifies the repricing.
But sir, this price hike in Mediclassic was done under.
Sir, Mr. Goda, may we request that you return to the question queue? There are participants waiting for their turn.
Okay. Yeah.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to 2 per participant only. The next question is on the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, good morning, everyone. Firstly, what would be your guidance for the claims ratio and combined ratio for this fiscal now? Earlier you were alluding to something like a 64% kind of a loss ratio and a combined of around 94% or 93-94% for the full year. Do you think that the same can be achieved now given the Q1 number? My next question is on the premium growth for the full year. You have alluded to in the past of doing the retail health book by 25%. We still below that for the first quarter. So do you think that the premium growth can also have to be trimmed down? And in that again, so you've already seen a 18-19% growth in sum assured per policy. You've taken a price hike of around 20% in one of your flagship products. You had taken a 15% price hike last year in one of the key products. So pricing and your sum assured per increase and number of customers, how do you see this will play out when you give a guidance for a premium growth in this year? That would be my question.
So as far as our guidance for claims ratio is concerned for the full year, we stick to our original guidance of around 63 to 65%. There will be seasonalities. Claim ratios are not a straight line. Health insurance claims go up and down depending on various factors. But we maintain our guidance to 63 to 65%. As far as our combined ratio guidance is concerned, we have mentioned that we are looking at 93 to 95% as the overall combined ratio for the company.
Sorry to interrupt. Mr. Jain, there's a lot of disturbance from your line.
I'll mute myself.
Thank you.
Yeah, as far as the premium growth is concerned, Star Health will continue to be a retail-focused company, and we have grown double than the industry's growth rate as far as the first quarter is concerned in the retail business. And we are going to be very selective as far as underwriting large corporate business is concerned, while focusing on the SME and the smaller mid-sized corporates. Growth in premium, we are very confident of the guidance that we have given in terms of retail business. We will be able to grow at more than the industry's growth rate, and we hope that we will be able to achieve between 20 to 25% growth rate in the retail segment. As far as overall growth is concerned, there might be a muted growth because of the group segment, but then that is by design and not by any other, it's not because of a chance. The growth opportunities in the business is substantial. The awareness of health insurance is, as you're aware, is has become very, very high. We have opened up new vistas of growth like rural markets. We are investing big time into the rural strategy, and we expect good growth to come from there. Our bank assurance partnerships are also taking shape very well. We are tying up new banks every quarter, and we expect that this plus rural and also our digital business, which is our core focus area, apart from the agency model that we have obviously as a mainstay of our business. All of these put together, we are very confident of doing very well on the retail business growth and growing much, much faster than the industry. And, that is going to be our game plan.
Yeah, thanks. What would be the quality of the retail book that you are sourcing from rural India today? Do you think that the loss ratios there could be higher, or how would you rate that book?
So the rural markets, the initial, the signs that we are getting is very positive. We are seeing, there is not the average ticket size in the rural business is also very close to what we are seeing in the semi-urban and urban markets. Of course, metro cities will be quite larger, but we are very positive because the quality of business coming in is very good. Our loss ratios are definitely much better right now, but we are also looking at very, very granular distribution in the rural markets. We have opened up close to 300 spoke locations and 200 branch offices. So there are already about 500 distribution outlets in the rural markets. And when I say rural, I mean really rural. These are not small towns, but we are going into cities which are less than, villages and towns which are less than 1 lakh population. And I think, we are very excited about this particular growth.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good morning. Thank you for taking my question. Congratulations on a good set of numbers. First, I think you mentioned in your opening remarks that you've taken a price increase in a product of about 25%. I missed, what product is it and what is the share of this product in the GWP that we write, if you can give that. Second, if you can talk a little bit about the CSC initiative and the tie-up and how large it can potentially be in the next sort of couple of years. That will be helpful. And third, on the ESOP expenses, I believe this quarter that's about 55 odd crores. What is the timeline for this? So how much will it be over FY23-24? If you can give those numbers out. Yeah, those would be my 3 questions. Thanks a lot.
So the Mediclassic product is the product we have taken a price hike. This is basically one of our oldest and most popular products, but it contributes close to 6% of our retail GWP, and we have taken a price hike on that. What we have about your second question about the CSC. Now, CSC, as you are aware, is a Government of India initiative, and there are about 5 lakh functioning outlets across the country. And Star Health is the only SAHI company which is on their platform. The opportunity is very large. We have just finished our technology integration on their platform. So training activities of all these CSC members and the village level entrepreneurs is going on. We will be able to give you more guidance about exactly what numbers we are planning probably in the future. But right now, We believe that, given the distribution and the brand of Star Health and the service capabilities of ours in the rural markets, we will definitely be able to, garner substantial market share here. As far as the ESOP expenses is concerned, I request Nilesh to...
Yeah. So, Madhukar, in terms of ESOP, we have expensed around 55 crores. As discussed during the last call, this is a one-year vesting period started from 1st December 21 and which will end on 30th November 22. So, for the rest of the year, there will be another impact of around 74 crores. Q2 will be 55 and Q3 will be 36. That will be the end of it. There will be no impact in 23-24. It will be from 1st April to 30th November 22. Total impact of 145 crores for the current year.
Got it. Thanks a lot. Thank you, sir.
Thank you. The next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Thank you for the opportunity. So I have three questions. First is on your net commission rate. So that has come at around 13.7%. For the first quarter. This is in line with the full year FY22 number. Now, given that the loss ratio is declining and the reinsurance commission that you earn is on a rolling basis, shouldn't this net commission ratio would have been lower because, your reinsurance commission should have been higher? That's my first question. Second is on the net profit. So the net profit, I understand first quarter is, going to be a little weaker so that there will be a reserve reversal. So going ahead, should we expect as the momentum of business increases, your reserves will go up? So should we expect first quarter PAT to be the highest among all 4 quarters? I mean, I just wanted to understand the sustainability of 200 crores of PAT over the quarters. And the last question is a little more macro that way. It's about your rural business. So as far as we understand that there are so many government policies, government insurance plan, and what is your how do you expect to grow in the rural market where more number of people will be covered by the government insurance plan? Do you think they will need a private player's insurance policy? So the sustainability of your rural business is the last question.
In terms of net commission, we only have obligatory reinsurance, which is now 4%. In obligatory reinsurance, the commission rate is fixed, unlike sliding scale, which is available in quota share treaties. So for us, even though the loss ratio is improved, the net commission ratio will be in that range because 98% of that cost is the commission paid to the agents, and the obligatory 4% is obligatory. On that, we get 15% commission. So we don't see any change that will happen in spite of the reduction in the loss ratio in that segment. Of course, with more and more benefit products, the reinsurance commissions will improve, and that will have an impact on the overall commissions ratio. So that's the focus on the benefit business, which will help in the reduction in the net commission ratio. In terms of profit after tax for quarter one, yes, quarter one will be the highest, a better profit quarter compared to the other 3 quarters. But the true profitability for insurance companies is the combined ratio, which keeps on normalizing as we keep on moving forward, and that's the potential of the business. As long as we are able to maintain the combined ratio at the levels that we are talking about, 93 to 95%, the investment income continues to be robust. We'll be meeting the guidance that we have given in terms of profitability. Macro insurance.
So as far as the rural business is concerned, we are extremely positive about the opportunity here because we are seeing, good demand, and as I told you, the average ticket size in the rural business is also relatively higher than what we had initially expected. We believe that, the rural markets do have a good potential because the awareness and the need for, quality health treatment is being felt even in those areas. Government businesses are not our direct competitor because they are catering to a different segment of the society. They are targeting the rural, the middle income group and the rural upper income group. So we are not looking at the below poverty line segment, which the government scheme generally target. So we are very, very confident about our rural strategy, and we expect that it will be a good, profitable growth driver for the organization.
Got it. Thank you, sir.
Thank you. The next question is from the line of Ajok Frederick from Unifi Capital. Please go ahead.
Thank you for the opportunity, sir, and congrats on a very good set of numbers. So I just have one question, particularly with the regulatory front, where the regulator might allow life insurers to sell health insurance products. So what is our take, number one? Number two is, if at all, let's say, they come out with the guidance, what is our next step after that?
See, health insurance, we always believe it is service intensive. And the capabilities that we have built in, we have the experience of handling more than 8 million claims. And we are very confident that, we can prove our efficiency through our services and continue to remain as a market leader.
Sir, but still, I was coming from the angle that agency, particularly LIC agents, who have a good overlap, might tilt towards LIC, right? Or for that matter, any other life insurer.
That's why I'm trying to say that something which creates stickiness for the agent is the service efficiency of the organization, the scale and reach, their presence, their brand image, which we all have a mile of that.
Got it. And what is your sense, like, will it happen, like, if at all? Any indication from the regulator?
That we have to wait and see. It's not our decision primarily.
Yeah. Sure, sir. Sure. That's it from me, sir. Thank you, and congrats once again.
Thank you.
Thank you. The next question is from the line of Neeraj Toshniwal from UBS. Please go ahead.
Hello. Just wanted your thoughts in terms of claim ratio between the retail portfolio and the group portfolio, if you can share. And the growth of 20% in the retail portfolio, if you can split further between the price hike and the growth in terms of volume and value, that would be helpful. Because if I look at the claims on sequential basis, it has been very flattish, despite obviously due to the technical unwinding of the reserves. It looks optically much lower, but otherwise it's there, almost there where it was. So just wanted your thoughts about these two things, then I can ask another question.
The loss on group portfolio, it all depends on, so many factors. The underwriting philosophy that we follow, the type of group, as my colleague Anand was pointing out, we are trying to do a very selective approach to acceptance of a group cover. We are looking at SME and medium corporates, and we are trying to look at the burning cost and our valuation, and then trying to accept the group. So, and we have started this strategy from mid-January, and we are able to see a good progress and a very, very profitable group loss ratio after we have started following this strategy. So, our mix of retail and group, as you have been watching, watching us, committing here, we are going to be more dominant in the profitable retail segment, and we have the wherewithal and the manpower and the technological efficiency to create this continuous profit in this retail segment.
So, but can we have the number in terms of the loss experience between the group and the retail?
So that's not in the public domain, the group and retail loss issues.
Sure. Okay. So the unwinding of the group portfolio, how much delta we are expecting to come in the improvement in the loss ratio going ahead? If that you can give some color on that.
We're not able to get the question. The overall loss ratio guidance that we have given, the 63 to 65%, as group keeps on declining, it will have an impact on the overall loss ratio of the company.
Okay, and the spread between the price and the volume, or price hike and the volume, if you can get tell more on that in terms of the 20% growth in retail portfolio? How much would be coming from price hike?
Typically around 7 to 9% is the value growth that happens on account of the natural increase in the age buckets, the sum insured increase that we have taken, the price increase that we have taken, and the balance is the volume growth that's happening.
7 to 9% coming from price hike. And given this launch of new product, the new upgraded version in Star Health Assure from Family Health Optima, any price increase we have taken, or how with the new features in terms of the viability? Just wanted to understand because the major product for us, how will things change in terms of overall growth and the premium growth and the loss ratio going forward?
See, in the new products like Health Assure, Women Care, and Star Premier, we have come up with a lot of innovative features which are much required in the current status. We have included a lot of upcoming specialties. We are trying to give cover for baby born from day one. We are including specialties, upcoming specialties in medicine, like rehabilitation medicine, hospice care, pain medicine. And so we are looking into the growth and success of the healthcare services and the requirement of the common man. And we have incorporated all those value-added features in this new product, and the new products are also priced appropriately. So we are very confident that we are going to grow more on this new product, and this can essentially help us to increase our average premium and also control our loss.
Got it. This is very helpful. Thank you. That was my questions.
Thank you.
Thank you. The next question is on the line of Jayant Kharote from Credit Suisse. Please go ahead.
Thank you. So I just had one question on the Youngstar product. How has it done in the first quarter? And if you could talk in general, the direction of the average age for the incremental business, is it better than at the portfolio level, or how is it moving? That's the only question. Thank you.
Youngstar is a product which is well received, and we are seeing the loss ratio also within the calculated numbers. And we see that there are a lot of traction on this product. A lot of youngsters are showing interest, and we are also giving a discount on the premium for people maintaining good health in this product. So that's a very that's very well received. And we could see that Youngstar today constitutes around 12% of our performance compared to all products.
Sir, is the growth in Youngstar better than overall retail growth or in line?
So it's more than what we expected as we launched this product. We can call Youngstar as one of our successful products.
Okay. Thank you very much.
Thank you.
Thank you. The next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah. First question, moving forward, if the losses comes as per expectation, largely, by end of Q2, you are going to move to claims. So by year end, of course, there will be two moving parts. You will have sort of organic capital accretion as well as, solvency moving from, claims to premium. At the same time, premium growth. So by year end, broadly, if things go as per guidance, where will solvency end up at FY23? More closer to 200% or 190%? So that's the first question. And second one, going forward with, the kind of relatively degrowth in group that largely happened, but still overall growth going to be a bit, slightly on the lower side because of the group impact. By year end, of course, once this quarterly things normalizes and your, OPEX and claim movement, what will be the ex-commission OPEX ratio that you would see in FY23? These are my two questions.
In terms of solvency, what we believe by year end, as we keep on moving towards premium basis and quarter four, which is the biggest quarter, we believe the solvency should be in the range of 193 to 198%, in that range by year end. In terms of expense ratio, we have given a guidance 93 to 95%. We believe, and with the loss ratio of 65, we believe our expense ratio will be around 30% by the end of the year.
Okay.
It will be better than last year.
Okay. Clear. Okay, thanks.
Thank you. The next question is from the line of Bharti Savan from Mirae Asset. Please go ahead.
Hello. Thank you for the opportunity. Sir, my question was more on the channel growth fund. Just wanted to hello, am I audible?
Yes, ma'am, you're audible.
Yeah. So just wanted to understand, within the digital channel growth of 29% which you've shared, what would be the growth of our own channel, and what kind of growth would be coming from web aggregators or other platforms?
So our own direct channel is growing faster than channel partners. So we are noticing close to more than 35% growth on our direct channel. And we are investing more on our direct business because, as you are aware, the direct business is more profitable in the long run because there are no trailing commissions, and we are also able to control the quality of business. So that is going to be the main focus area for us. Today, the direct business is almost 60% of our overall, digital business, and all other channel partners constitute, the balance 40%. So that's the kind of business that we are driving. Other channel partners have grown, I think, around 20% on the online space.
Okay, understood. And sir, just one more question on the IRDAI, the regulator front, wherein they've allowed the banca channel to opt for 9, or as in they can go for the 9 insurance. So does that help us in growing the offline mode faster, or our focus is more on the online side only?
No, definitely it's a very positive move for health insurance because we are growing our banca channel exponentially and growing much faster than our overall business. And if new partnerships can come through because of this, if this happens, the opening up of the regulations happens, I'm sure that, being a market leader, there will be a lot of partners who will naturally gravitate towards Star Health Insurance. And we already have enough inquiries which we are not able to get into because of this restrictions currently. But I think this will open up a good opportunity for us.
Okay. That's it from my side. Thank you so much.
Thank you. The next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, good morning, everyone. Congratulations on a great set. So a couple of questions from my side. So which all products, or if you could quantify the number of products which are already in pipeline for repricing, even if you could not name them, but at least give us some sense if there are some products in the pipeline for repricing. Second was on what is the median age of the new book which we are writing, given the kind of increase in the sum assured. So what's the median age of the new book versus what's the median age of the existing book, and also what's the medium sum assured of the new book which we are writing. And the third one was on the new product which we have relaunched. In the pricing differential compared to the Family Health Optima which was earlier there. Yeah, that's the one.
See, as far as price revisions of other products are concerned, we will not be able to comment on that right now because these are not, some things that we would like to comment in advance. We are a company where we are constantly reviewing our products, and if at all it is required to take a price revision, we take an overall comprehensive view, and then we take a decision to go ahead with it. And as you know, right, currently with the new use and file regulations, this has become even more, we are more agile towards this particular, price revision. So we do not intend to make any comments on that. But as far as our average median age and median sum insured is concerned, the median age right now is around 41 years, if I'm not mistaken, and the median sum assured of the new products that we are seeing is around 8.5 lakhs, which we have disclosed already in the presentation.
And what would be the median age of the new book which you are writing?
It will be similar to 41 years.
Got it. And so if you could quantify the total cashless claims from network plus non-network hospitals, that'd be great.
So the focus is more on encouraging customers to go to network hospitals, because in network hospitals we are aware of their presence, their performance, their quality, their expertise, and the level of infrastructure and their accreditation status. So we always encourage customers to go to network hospitals, and our participation to non-network hospitals is gradually declining year on year and quarter on quarter. We would see that hardly 13 to 15% of the outgo happens to non-network hospitals.
Got it. And this decrease in the share of cashless, is this a conscious approach which Star is taking to curtail the share of cashless claims, given the kind of fraudulent claims which are being reported in the industry, and just to get a sense?
See, Sahej, what we mentioned is the ANH part is what we have shown in the presentation is 56%. So total cashless is 80%. Out of the 1800 crores of claims that we have paid, cashless is 80%. Out of the cashless, 56% is towards agreed network hospital. So as we keep on increasing the penetration, there are certain kind of illnesses which are not, available for agreed network hospitals kind of a thing. That is what even Dr. Prakash had mentioned.
Got it. Thanks for this. That was all from my end.
Thank you.
Thank you.
Thank you all.
Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Nilesh Kambli for his closing comments.
Thank you all for joining this call on Saturday. It was a good quarter for us, and we are confident we'll be able to achieve the guidance that we have given for the next 9 months and the whole year. Thank you all for the participation.
Thank you. Ladies and gentlemen, on behalf of Star Health and Allied Insurance Company Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.